Hey, welcome back to the 40 Finance channel. Today I'm going to talk about a small stock that I own called Magnite, and this is an ad tech stock, so particularly on the side of connected TV. Now, unlike all the hoopla you hear on the buy side of ad tech for places like Trade Desk, Google, etc., where advertisers are purchasing ad inventory, Magnite's a little bit different because they help you sell your inventory. They're a sell side provider. So Magnite essentially helps you optimize your advertising inventory and earn the most from that. And one clear differentiator for sell side with Magnite on the connected TV and even linear TV space is the fact that it is not dependent on some of the cookie tracking that you've heard about in the news. So if you're interested in ad tech, you're interested in connected TV, but you're worried about the iOS tracking update, which has cost, Facebook $10 billion or something in 2021, then this could be a small stock that's worth a gander over the long term. So let's jump in. I'm going to give you 3 things to know about Magnite stock right now. Okay, the first thing to know about Magnite is just to really understand what their offering is as an ad tech stock. So straight from the horse's mouth here, we're Magnite, global alternative to ad tech's walled gardens. And this is the key, right? Because we know that Google, Facebook, Apple, they're all putting up barriers around their world, and it's getting harder and harder to track customers from website to website, app to app. And this is where Magnite comes in because they skip a lot of those walled gardens because they focus primarily on video and connected TV advertising. Magnite is the industry's largest scaled independent CTV video ad platform. Though CTV and video are now as important to Magnite as ever, we remain committed to our roots as an omni-channel sell-side platform. Thousands of publishers around the globe rely on our technology to sell advertising on their terms and across every channel and format, including connected TV, desktop, mobile, and audio. So the point of sharing that with you is just to have a really good understanding of what Magnite does, because there's a lot of ad tech stocks out there right now. Trade Desk is obviously probably the most renowned once you get out of the mega cap FANG names. But Magnite is a completely different play than the Trade Desk, right? They're only on one side. So it is a smaller market than what the Trade Desk offers people, because the Trade Desk is back and forth across numerous platforms, whereas Magnite is basically buying the real estate to sell the advertising on. Okay, now the real game changer for Magnite, in my opinion, came last year when they finally closed the acquisition of SpotX. And so SpotX is basically a marketplace, right, where advertisers can view the inventory available on Magnite's real estate that I keep referring to. So if we scroll down here just a little bit, you get an idea of their partners that they work through. So they're offering the most diverse supply of premium video advertising real estate that's out there, and it's a pretty good list. Some of the names, okay, they did have Fubo. The big acquisitions here lately, the big contracts here lately have been AMC, Fubo, Fox, and the Disney one was extended last year. Okay, so that covers the what is Magnite and how do they make money portion. The second thing to know about this stock is that it's a relatively inexpensive play, particularly from a valuation level, on the growing connected TV space. So here's the stock overview, $13.37. That's not necessarily what I meant by inexpensive play. We'll look at the valuation metrics here in a second. The most interesting part, particularly for me, is that I bought into this not quite at the highs when it's peaked at 61.80 in February, but I think I started under the $30 mark, somewhere in there, and I've managed to average down over time to about $22. I have 300 shares, at $22. So I'm still deep in the red. And if we look at the year to date here, the year to date hasn't been so hot. Now, they did just come out and have a pretty good earnings report where they hit their numbers. They missed on EPS by a couple pennies, but overall, revenues were up, partners were up, all the things that you're hoping to see out of a small cap stock. So going back to this chart here, from a 1-year basis, you know, it's got falling knife written all over it. However, you did have a big momentum play starting yesterday, and it's down today, but I think it was up roughly 15% or so yesterday after earnings. So hopefully things are turning around, and that's part of the reason, frankly, that I'm doing this video today, is we had a small momentum shift yesterday. Now, let's take a look at our valuation metrics. And valuation grade of D, this is in SeekingAlpha. By the way, SeekingAlpha platform, if you're interested, my affiliate link is in the description of this video, offers you a significant discount on a 1-year subscription to SeekingAlpha Premium. But getting back to this valuation grade of D, you know, SeekingAlpha has their own quant formula. And you see with this grade, you're getting compared to sector relative, so you're going against everybody in communication services. Trailing 12 months, non-GAAP PE 2487. Looking ahead, perhaps they get down to the 18s. I will say that this is a company that rides very close to the line on profitability. So this is not a shoe-in like Google where you're going to have 20% EPS increase every year. They're just too small to pull that off right now. Now, if we go down to some of the other ratios, if you want to get into EV sales, you're at 443, EV to EBITDA forward, 1189, price to sales forward, 3.29, and then price to cash flow forward, 7.89. All right, taking a look at EPS estimates going forward, December of 2022. You know, this is going to be a weird number, 74 cents. Hopefully they hit it. But you can see the range out of 8 analysts goes from 50 cents to 92 cents. If I was really going to haggle over EPS, I would lean towards the low end if that's how you're doing your valuation, only because company this small, it doesn't take a ton to lop off 5 cents of EPS, right? So if you're worried about it, play on the low side. I'm perfectly fine with the 74 cent consensus estimate. There's your forward PE of 1805. And then in December of 2023, again, very hard to speculate, but let's just pretend they get to $1. That puts your forward PE at about 13. All right, how about on revenue estimates? The company has basically come out and said, you know, we see 25% plus for the next at least 2 or 3 years. And assuming connected TV grows and they grow internationally and all those things, then that plus 25% could go for many more years. But for right now, if they hit their estimate of 537, that'd be a 30% growth. If they hit it next year, 647, that's saying 20% growth. In regards to this 20%, I will just say that in the earnings call, they're speculating 25% right now. So this might be coming in a little light. All right, and the third thing to know if you're tracking this stock is there are some sort of muddled financials in here, okay? And that's mostly because of the acquisition. So we looked at the SpotX website hit there just a few minutes ago. That was a key acquisition that didn't close until 2021. And even prior to SpotX, they came onto the market as 2 companies combining into one. So there's nothing wrong with that, but I'll tell you what the negative is for it on the street. So first of all, people are going to look at organic growth, right? So while you're producing more revenue at the top line, everyone who's going to get nitpicky about it is going to look through and say, well, how much came from this company? How much came through that company? And are they growing organically, right? So that sort of rotates back into worlds of like users. You know, if you're thinking about Facebook or Netflix, you know, the street likes to see that whatever the hell you have, that people are banging on the door to get some. That's what they want to see. And with Magnite right now, they're closing acquisitions. They're finally getting to a comparable standpoint here in 2022, but that won't even be the case through the full year. It'll be 2023 before they have like real financial comparables, and that's what makes it hard for some people to invest in the stock. So one of the big things you'll see on all their earnings releases is this word here, revenue ex TAC. So that's revenue ex traffic acquisition costs. And you basically have two forces playing at traffic acquisition costs, right? The first is the reason they use that metric is because of the SpotX acquisition, and they're trying to sort of make an apples to apples play on how much revenue is growing. And then the other part that sort of muddles up the scene is because they're selling other people's ad inventory, right? They don't own Hulu, they just have rights to the advertising space. Hulu isn't partnering with Magnite just to give away the farm. They want an easy way to get the checks passed over to them without fretting what that forecast is going to look like. And Magnite takes it to the next level and resells and creates a spread between the 2 points. So those two things are summarized here in this paragraph. Traffic acquisition cost, a component of cost of revenues, are what we must pay sellers for the sale of advertising inventory through our platform for revenue reported on a gross basis. Revenue ex TAC is a non-GAAP measure and should not be viewed in isolation. We believe revenue ex TAC is useful in assessing the performance of SpotX and in assessing the performance of Magnite as a combined company with SpotX post-acquisition because it facilitates a consistent comparison across our core business without considering the impact of traffic acquisition costs. So all those words there are the two forces I tried to explain better. You've got the SpotX acquisition that really hurts with getting pure comparables. And then on the flip side, even though you might have sold Hulu inventory, let's just say for $1 million, you still have to pay Hulu. They weren't giving you that straight off the bat. And maybe you have to pay them $800,000 for that real estate, and you keep the spread somewhere in the neighborhood of $200,000. Now that's a completely made up example. Their margins are running better than 20%. All right, so those are three big things that you need to know about Magnite stock right now. First, we talked about the overview of the company as a whole. We followed that up with some stock valuation metrics. And then the third thing is, at least from my perspective, one of the big drags of this stock right now, and that is sort of the muddled paperwork behind all the revenues. Now, with all that in mind, I think Magnite's a solid play here, particularly at the current price of around $13. And I feel good that the company has positioned itself to expand its business, which, by the way, they can do now really just by signing more clients. The SpotX acquisition has provided the technology. You can go down all the press releases, and Magnite has a very good standing in terms of partnerships with places like the Trade Desk and some of the other digital TV platforms. So I would say their political standing in the industry is in great shape, and that's sort of an extrinsic factor, but it comes into play when you're making relationships, and this is going to be a relationship-based business to get more inventory to pump into the system. Now, as far as price projections go, if we get to the back half of 2022, and we start to see the $1 non-GAAP EPS estimate stabilize for 2023, then I could definitely see this stock going to $20, maybe a buck or two above that, 21 or 22. And that's a pretty darn good return over a 1-year period for a $13 stock. So for my money, I'm probably going to buy another 100 shares in and around the current price, bring my cost basis of $22 down even further. And then as the stock goes up, as the year moves on, I'll probably sell some covered calls against it, try to make a couple bucks that way. But I really do think that the long term for this one, call it 2, 3, 4 years, looks pretty exciting, at least with the news that we know today. All right, investors, let me know what you think about Magnite stock in the comments. Don't forget to check out the Seeking Alpha special offer down in the description. And as always, thank you for giving the video a like, sharing with your friends, all the things. We'll see you on the next video.